From gold, fixed at $35 an ounce under Bretton Woods, to the end of gold convertibility in 1971, to the end of 2025. 27% of total official reserves in gold, 22% in United States Treasuries. For gold investors, that sounds like vindication. For anyone who does not own gold, it may sound like a distant accounting contest. It is not. The consequences can reach exchange rates, mortgage costs, pensions, taxes, and imported prices. For Washington, it sounds like a warning about one of America's greatest financial advantages: global demand for its debt. For Asia, it tells two stories at once: continued dependence on dollar liquidity alongside growing efforts to diversify. For Europe, it raises another question: can the euro become a stronger reserve alternative, or will fragmented government bond markets leave gold as the easier choice? And for central bankers, banks, businesses, and policymakers, it raises the most practical question of all: what now counts as safe? A United States Treasury is, in simple terms, an IOU from the American government. A central bank lends money to the United States. Washington promises to repay it on a set date and normally pays interest. These IOUs can be bought and sold quickly. Central banks can earn income from them, sell them when they need dollars, or use them as security to borrow cash. Gold is different. It pays no interest and is harder to use in daily finance, but it is not an IOU. It does not depend on another government keeping a promise. Gold's role is not new. For centuries, it was the ultimate settlement asset between states. After the Second World War, Bretton Woods placed the dollar at the center, but the dollar was still tied to gold at $35 an ounce. Foreign central banks could exchange dollars for American gold. Then, in 1971, the United States ended that convertibility. Gold stopped formally anchoring the system, but the dollar survived through the size of the American economy, global trade, international banking, payment networks, and the enormous Treasury market. Treasuries became the working reserve asset, interest-paying, electronically traded, usable for dollar liquidity, and accepted as collateral across global finance. Gold remained on national balance sheets, especially in Europe and North America, but often looked more like inherited insurance than the system's daily operating asset. So the real story did not begin in 2025. It began when gold stopped being the system itself and later returned as protection against the system's risks. After the global financial crisis, central banks became annual net buyers of gold from around 2010. That was long before the latest wars, sanctions, or artificial intelligence boom. The pace then accelerated. Central banks bought more than 1,000 tons a year between 2022 and 2024. Purchases slowed to around 850 tons in 2025, partly because gold had become so expensive, but remained historically high. Recent events did not create the shift, they accelerated it. Reserve freezes, wars, inflation, rising government debt, trade tensions, and concern over access to payment networks made an old question more urgent. Is a reserve safe because its issuer is trusted, or because no issuer controls it? AI belongs around this story, but it did not cause it. AI is driving investment in data centers, energy, semiconductors, and strategic infrastructure. That can increase borrowing needs and competition between economic blocs. But central banks began returning to gold years before the current AI cycle. So are they preparing for one crisis or for a world in which fragmentation has become normal? Countries are buying the same metal for different reasons. For the United States, the issue is the advantage created when global reserves flow into treasuries. For Europe, the picture is more complicated. European central banks already hold large gold stocks, and the euro is the world's second reserve currency. But Europe still lacks one unified government bond market with the scale and consistency of United States treasuries. The ECB argues that the euro needs deeper capital markets and a larger pool of safe, liquid European public debt if it is to become more global. Poland's rapid buying reflects security and national balance sheet strength close to the war in Ukraine. China is diversifying a very large dollar-centered reserve position. India combines modern diversification with gold's deep historical importance. Turkey shows that gold can be accumulated in one period, then mobilized when currency and import pressures intensify. So Asia is not abandoning the dollar as one bloc. Europe is not automatically replacing it. The same bar can represent geopolitical insurance, inflation protection, currency defense, or diversification. Now comes the part most headlines miss. At the end of 2025, gold represented 27% of total official reserves, compared with 22% for United States Treasuries. But gold's price rose by around 60% during 2025, after rising roughly 30% in 2024. That repriced the gold central banks already owned. No new bar had to enter a vault for its reported value to increase. Reserve systems simply mark the same holdings to the new market price. Use the end of 2023 gold price, and Treasuries would represent about 26%, while gold would fall to around 16%. So valuation produced most of the crossover. But the underlying trend remains real. Central banks had already been buying gold for years, with China, Poland, Turkey, and India among the largest purchasers since 2022. The price surge created the headline. The policy shift created the conditions beneath it. Gold has one strategic advantage no government bond can copy. It has no issuer. If a country holds physical gold under custody, it trusts the asset is not another state's debt. That matters when reserve managers worry about sanctions, jurisdiction, or access to financial networks. But independence is not the same as operational usefulness. Gold pays no interest. It costs money to store. Its price can move sharply, and supply cannot expand quickly when the world suddenly needs liquidity. Treasuries perform jobs gold cannot easily replace. They generate income, trade at enormous scale, can be sold for dollars quickly, and serve as collateral throughout banking and capital markets. Even the Treasury market can come under stress, but no other single asset currently combines the same volume, infrastructure, and direct connection to the world's dominant currency. Reserve managers are therefore balancing two different forms of safety. Gold offers protection from issuer dependence. Treasuries offer liquidity inside the operating system. A country may want both because neither can perform every job alone. But suppose the shift went much further. What if gold did not merely overtake treasuries by market value, but began replacing them as the principal reserve asset? The United States could face weaker structural demand for its debt and higher financing costs. Central banks would give up interest income because gold pays no coupon. The global collateral system would need alternatives. Treasuries sit beneath repo markets, derivatives, bank liquidity, and central bank operations. Crisis liquidity could become harder. A treasury can be sold electronically for dollars. Gold must be sold, lent, swapped, or pledged through specialist markets. Gold itself could become more volatile because its supply cannot quickly absorb a massive change in official demand. And the reserve system could fragment into different combinations of dollars, euros, renminbi, gold, regional payment networks, and digital currencies. That may mean more currencies to hedge, more settlement routes to manage, and more political boundaries inside global finance. This is not today's base case. In the first quarter of 2026, the dollar still represented just over 57% of global foreign exchange reserves. The euro was around 20%. The renminbi remained below 2%. Gold has challenged treasuries in reported reserve value. It has not replaced the dollar's operating infrastructure. Central bank buying is not household investment advice. A central bank can hold an asset for decades and absorb price swings that would be unsuitable for a family saving for a home or retirement. The wider lesson is how reserve choices travel through the economy. Greater currency volatility can raise business hedging costs. Higher government borrowing costs can flow into bank loans and corporate finance. A weaker domestic currency can raise the price of imported fuel, food, medicine, machinery, and technology. Pension funds and insurers hold large bond portfolios, so changes in yields and currencies can affect funding and returns. Governments facing higher financing costs may have less room for public services. Companies may delay investment or hiring when finance and cross-border costs become harder to predict. You do not need to own a gold bar for the reserve system to reach you. It can arrive through the exchange rate, the mortgage rate, the pension fund, the employer's investment budget, or the weekly cost of imported goods. So, what have we learned? The headline is real. Gold overtook United States Treasuries in reported official reserve value. Valuation produced most of the crossover. But the structural trend is also real. Central banks have been buying for years, and recent wars, sanctions, and uncertainty accelerated a movement they did not create. Gold and treasuries are not simple substitutes. Gold offers independence from an issuer. Treasuries offer yield, liquidity, collateral, and access to the dollar system. And the dollar has lost some exclusivity, but not its operating dominance. Yet the larger questions remain. If the United States continues issuing more debt, will global demand remain strong enough to preserve its financing advantage? Can Europe build a deep, unified, safe asset market and make the euro a stronger global alternative? Can Asian economies diversify without weakening the trade and financial networks on which they still rely? Will AI investment, digital currencies, stablecoins, and new payment systems reinforce the dollar, or accelerate a more fragmented architecture? And if the next crisis tests both market liquidity and geopolitical access at the same time, which form of safety will governments value most? Gold has not defeated the dollar. It has exposed a question the world has not answered. Can one asset still provide every kind of safety the next financial system will require? This is Lessons Untold. We look beyond the spectacle to understand the money, technology, people, and systems shaping the world around us. If this video gave you a new perspective on gold and the global reserve system, subscribe and join us for the next story.